Let's say, for instance, you won $1 million on a scratch a ticket. Yep. And they're going to come to you and they're going to say, we can give you $1 million, or we can give you like whatever, $1,000 a year, $10,000 a year for X period of time. Who would ever take the latter? Like, even if there was a discount, you're still going to take the cash right now. And that's exactly the same. This is like the concept when the CPA comes and says, oh, you're just going to have to pay it back.
Welcome to the Ral Room Assisted Living Podcast with your hosts, Charlie Cameron and Alex Schlau. This is your go-to show for cutting-edge insights from industry leaders in residential assisted living.
Whether you're ready to launch your own assisted living business or looking to invest in this fast-growing, high-impact sector, we are here to equip you with the tools, strategies, and confidence you need to succeed. Get ready to ride the silver tsunami and change the future of senior care. Now on to today's show.
Welcome back to the Ral Room Assisted Living Podcast. I'm your host, Charlie Cameron, and today we're diving into one of the most misunderstood but wildly powerful strategies in real estate investing, and that's cost segregation. And we've got the best of the best here to break it down, Miss Kim Lockridge, Executive VP of Engineered Tax Services. Welcome, Kim.
Hi, Charlie. Thanks for having me on the show.
So excited to have you here. You've been an integral part of our Ral Room Mastermind. I know a lot of folks were extremely excited when you came to speak. And so I hope folks get as much out of this as I have gotten out of your calls and actually your services, right, to do cost segregations on some of our assisted living homes. Why don't you give us your version of a quick intro of who you are and what you do and how you got to helping thousands of assisted living owners do cost segregation studies?
Awesome. Thank you. Yeah, so my background has been in finance and accounting my whole life. So this has been something that was just right up my alley when it came to just taxes, and it's been a lot of fun. So I'm Kim Lockridge from the Executive Vice President of Engineered Tax Services. Our company has been around since 2001, so we're 24 years old, and I've been with the firm for about 17 years. So this is something that we've been doing for a very long time. That might surprise some of you because some people think that the cost segregation came out with the Tax Cuts and Jobs Act, but that's actually one of the myths that we want to debunk today. Cost segregation has been around since the 1940s, right? So it's been a long time that we've had court cases to substantiate what we know today as cost segregation. And personally, I am a real estate investor as well. I've been investing in real estate since the late 90s, and I've got a nice portfolio. And as far as getting to this segment, it's very interesting, the stance that I play, because we run somewhere between 400 to 600 studies a month across the country. And I see trends that a lot of other people don't see. Even people that are just heavy in multifamily, a lot of time they're heavy in a multifamily space in a certain region, where I get to see projects all over the country, which is really interesting. So I see the trends that are coming, and I see the things, and I see this Ral is obviously a big trend that is coming, and we're seeing now folks are transitioning from maybe short-term rental that aren't performing as well anymore, and they're transitioning into thinking about doing some of these Ral rooms or the Ral project properties, right? That kind of just led me naturally, right, to doing what we're doing. And because I've been doing this for such a long time, we kind of see that trajectory of what's coming next, right?
Yeah. There's of course a massive need for it. We talk about it all the time, so I won't rehash that here. But we just had a tax professional on, and that was pretty insightful, hopefully, for a lot of assisted living owners and soon-to-be owners. But let's start simple on cost segregation. What is it, and why should someone who owns an assisted living home care?
Yeah, it's very interesting. So let's just start with the what is it, right? So cost segregation, if you buy a property, you have a home, or any income producing property, your CPA is going to depreciate that over either 39 years if it's commercial or short-term rental, or 27 and a half years if it's residential. Rals tend to gear more towards the residential side because people are actually physically living there, right? So it becomes 27 and a half year. But what happens is you take the total cost of that property and you depreciate it over 27 and a half years. An alternative to that is that we can, because of these court cases, as I mentioned, that date back to the 1940s, we have the ability, the IRS allows us to take components of that property and carve them out and put them in faster buckets. Like your carpet's never going to last 27 and a half years. In fact, your roof is probably never even going to last that long. but they require that all the structural components of the building, your roof, your windows, your walls, your doors, the foundation, the utilities under the ground, those types of things stay in that long-term 27.5-year bucket. But the finishes and the site improvements, like your irrigation or your landscaping or your driveways or signage, those types of things would go into a faster bucket. Okay. Could be either 5 years or 15 years in these cases for these properties. So there's other buckets, but those are the ones we're going to primarily focus on during this discussion. So when we do that, when you buy a property, it's very difficult to ascertain how much of that property is your carpet, right, throughout the whole property, or how much did the roof cost, or how much did your plumbing cost. It's almost impossible. So the IRS says in order for you to reclassify these buckets, you have to have a qualified professional, either an engineer or somebody, a building professional, come in and identify all these assets and then carve them out and put them into buckets in accordance with the IRS regulations. It does require a third-party independent company to come in and break down those assets in that property. And so when you do that, now you have a portion of those assets. Say if you spend $1 million, you have a portion of that can go into these 5 and 15-year buckets, which get depreciated much faster, which in turn reduces your tax liability. So if you have income on the property and you have more depreciation, then that offsets that, so you pay less in tax. That's the concept. So that's essentially what cost segregation is. And where this really fits into Ral's specifically, and this is way better than any other property type, unless you're a real estate professional, but it acts. So if you have a property that you're operating a business in and you are actively participating in the business, then you actually have these self-rental rules. So hopefully, if you're structuring it correctly, you're buying the building in a separate LLC than the business is run. You don't want to hold those in the same entity. So you buy the building and then you have the business. And because you're common ownership, the same people, it's considered self-rental. And as long as you're actively participating in that business, you get to actively participate in the deductions or the depreciation of the property and have it offset the income from that business. Okay. So in this case, if you have a dentist and he buys a building and he personally buys the building and then his business rents it from him, those are self-rental rules that you can apply. Same thing here, right? As long as you're participating in the business actively, then you will be able to use those deductions. And the difference could be huge. Let's take that $1 million building, for instance. Trying to break this down into monetary terms. Say you have $1 million building and you're depreciating it over 27.5 years. This is, if you take the calculation, so it's $36,000 a year is what you get in depreciation, right? So you get to offset $36,000 a year of your income simply by just your straight line depreciation, right? That's what most CPAs would do. If you get a cost seg study done, and of course, depending upon the bonus depreciation, we're going to carve out about maybe 300,000 or 400,000 of that million to go into faster buckets, 5 or 15 years. So those shorten that time period, which gives you a lot more depreciation up front. And so as a comparison, instead of taking 36,000, let's say we have our 100% bonus depreciation back, which we fully anticipate, then that means you're going to take an immediate deduction when you buy that building at about 300,000 or 400,000 the first year instead of 36,000 prorated.
That's wild.
Right.
Wild.
So it's a massive difference, right? So that's where this sets apart from a single family home or like long-term rental or short-term rental even. And you might have material participation rules, and those, we won't get into all of that. But with this particular business type and it being a self-rental, highly effective for offsetting income.
Yeah. For the listeners out there, instead of taking 36,000 a year linearly, you could take just in that example. And of course, you have to run each property individually. But the example was somewhere between 300,000 to 400,000 of that $1 million total depreciation, 30 or 40% of the building cost in year one, which is wild. And of course, it depends on the bonus depreciation, which, as you said, we expect it to come back here, maybe today when the bill gets passed, we'll see. But I mean, it is just wild. And I remember when I did the first one, when I was more into Airbnbs, and the year before I paid a ton of taxes. Then I did 3 cost segregation studies. And the next year, I basically got all that money back.
Yeah.
And I was like, wow, like, whoa. And it comes down to the importance of the velocity of money in real estate and investing and in general, right? Any money that you can have in your pocket now is more valuable than doing it over time. People often get stuck in this trap, and maybe you can talk to it of, I shouldn't do the cost segregation because at some point I'm going to sell it. It's going to get recaptured. And then what? Even if all of it got recaptured, which isn't the case, then you would still have that money now that you could reinvest and do something with, right? Rather than just taking it slowly, $36,000 a year over time, which is hugely valuable. But do you have any thoughts on the recapture piece? Can you bust that myth for us?
Yeah, I hear CPAs all the time, not Brandon. Brandon's great, right? He gets it. But I do hear CPAs. I would say 90% of the CPAs out there are like, oh, if you do that, you're just going to have to recapture it and pay it back when you sell the property. But that's like the worst case scenario. And even in the worst case scenario, you have, like you said, deferred those taxes for however long you've owned it. So say you've owned it for 5 years or 10 years, right? And what you were able to do with the tax savings, say you take a $300,000 deduction and you're at a 30% tax bracket, that's $100,000 in your pocket that you get to use. Then you just got a loan from the IRS at 0% interest. So even if you had to pay all of it back, which you won't because it's prorated, but even if you had to pay all of it back, you got to borrow that money at 0% interest instead of going to get a loan to do your improvements or a loan to hire an employee or a loan to finish off some construction or a loan to go buy another one. So really start to think about it in those terms. I like to put it in layman's terms that people can understand. Let's say, for instance, you won $1 million on a scratch a ticket. Okay. You won $1 million on a scratch a ticket. Yeah. And they're going to come to you and they're going to say, we can give you $1 million or we can give you like whatever, $1,000 a year, $10,000 a year for X period of time, right?
Yeah.
Who would ever take the latter? Like, even if there was a discount, you're still going to take the cash right now. Why? And that's exactly the same. This is like the concept when the CPA comes and says, oh, you're just going to have to pay it back. What? Because that's, again, remember, that's the worst case scenario. Yeah. So let's say you buy a property and then in 5 years, and you do a cost seg study and you take all these deductions and you get to use those and offset your taxes for those years. And then you sell the property in year 5. Okay. You can do a 1031 exchange and you don't have to pay it back. Yeah. By the way, we're the home of the no cost 1031 exchange. So if you want a 1031 exchange or if you need to do that, we don't charge for those. So give us a call.
Oh, good to know.
Yes. And so do a 1031 exchange and then all that recapture that you would pay just rolls over into the new property. You don't have to pay that back. So how fantastic is that you have an option, right? And then the other option is a lazy 1031 exchange, right? So a lazy 1031 exchange is very similar, but you're not having to do a 1031 exchange. You essentially, in the same year you sell a property, you buy another one, and then you use the cost seg benefits to offset the gain from the one you sold. And it happens brilliantly, right? You don't have to worry about the 45-day or the 6-month requirements for the 1031 exchange. So those of you who maybe planned to do a 1031 exchange, but then couldn't find the property to identify or couldn't close within that 6-month period of time for whatever reason, all's not lost. You can do a lazy 1031 exchange, and that helps as well. There's just so many things out there. The other benefit to this, and about the whole recapture comment, is that in many cases, you're taking the deductions at ordinary tax rates, your highest tax bracket. And when you sell a property, there's capital gains tax, which is a lower tax bracket. So there's a 10 to 15% arbitrage, depending on what level you're at, that you're going to keep it anyway. So that's what I mean by you don't have to give all of it back. It's prorated, right? So when a CPA comes in and says, oh, you don't want to do this because, the whole next part of that is, well, what would we do in that case? What could we do to offset that? Take it one step further. Don't just stop it and say, oh, let's put a block in my path and now I'm going to stop. You find a way over the block, or you find a way around the block, or you smash the block. So we find out how can we get around this instead of just accepting the fact that we're not going to do this because maybe, possibly, in 10 years, I might sell this building.
Yeah.
Right? So
Yeah, we're talking about how the wealth get wealthier, right? Smashing the blocks and getting around the blocks. Like, how do you move forward with the lowest tax impact as possible so that you continue to grow your wealth? And so I think a lot of real estate investors start with, okay, 1031. That's an easy concept to understand. Cost seg, a little bit harder, but it's like the second biggest thing you need to understand if you want to build wealth quickly. This is a benefit that is there for you. It's in the tax code that you should do a cost segregation, which is wild, right? People are like, oh, but linear. It's no linear if you don't do that other piece that it recommends, which is wild. So the tax man wants you to do this. And I talked about this in the Brandon episode, but it's a way for the government to incentivize investors to go out there and create jobs, improve properties, build properties, and things that the government can't actually subsidize with money. So they subsidize it with tax breaks. So you get to have that advantage. And then with assisted living, of course, you have the business too, which then allows you to offset business income with the cost segregation, which is wild. So if you're not a real estate professional, which I am, and that's probably like the third strategy that I would talk about, is that, hey, if you've got an active business, oh, giddy up, right? Because now you don't need to be reps to really get the biggest benefit. Okay, so we just hit a lot of stuff there. Let's see here. When's the right time, I guess? I guess we've probably answered it, to do a cost segregation study. And definitely, I want you to answer this. When does it actually come into play?
Oh, good question. When should you do it? Okay. And this is interesting because there's a lot of myths around this too. Let's say you're going to buy this property and then you're going to put in a bunch of renovations. And then people think, oh, after all of my renovations are done, I'm going to go get a cost seg study. Okay. The ideal time to get a cost seg study is right after you close on the property. Okay. Before you do anything to it. And here's why. What we're doing in the cost seg study is we're tying to your purchase price. We're establishing to the IRS a baseline to prove what was there at the time of purchase. Okay. Even if it's not quite in service yet, getting a site visit done now so that all of your pictures match up with your original what was here. Now we can draw some from an appraisal or do some other things, but it's a lot easier if we're actually physically there. We can see the construction of the building. We know how much lineal footage goes from that chandelier to the breaker box, right? We understand the square footage of the carpeting in each room, right? So we're looking at that stuff. So the site visit first is very important. Even if you're not putting the property in service yet, it's important to get the site visit done, okay? So that's when you should do it, before any improvements. And then if you're spending more than $50,000 on improvements, I would suggest we can do an improvement study on the backside. We don't need to come out again, so it's a lot cheaper. But we have local people, but we've already been at the property. We already have the concept of what we're doing. We can compare it to everything. We get all the cost breakdowns and send us some updated pictures. And we essentially do the second part of it. That's the only time that we would not have to do a site visit, is because we've already done one. So the site visits are super, super important. And so you should do that at that point in time. And we talked about what properties, right? So we want you to understand too, that it's not just when you buy a property. Let's say you bought a property 3 years ago. Let's say you're ahead of the game. You bought a property, maybe it was a short-term rental and you're converting it to a RAL. In that case, you can still go back and do a cost seg study, right? It doesn't have to be a new property. You can have it sitting on your books and go back and do it. IRS, it's an automatic change. The IRS allows us to make up the difference coming forward. It's very simple. You don't have to file an amended return. They make it very easy for us, trust me. So those are the things that you want to be looking out for, and you want to make sure that you're establishing that baseline and proving to the IRS, what was there before you do any other improvements or renovations or anything like that on the property.
Yeah, I love that. And for all the RAL folks out there, hey, guess what? The renovations are also going to get cost segregated. So keep that in mind. One of the things that, and hopefully this isn't going too off topic, one of the biggest benefits of a cost segregation in my mind, especially in assisted living where things can get pretty expensive pretty fast, especially if you're developing, is the benefit that gets to be passed on to your investors. Tell us, Kim, why that's such a big deal for a lot of folks who have a lot of money but not a lot of time. Sorry to interrupt this episode, but let's be honest. Most real estate investing right now, it's either buy a fourplex or try Airbnb and hope for the best.
Yeah, we're not here for that.
We're here to show you what we believe is the most overlooked high cash flow real estate strategy in the game right now. You guessed it, residential assisted living. It's literally the one place in real estate where you can net six figures on a single home and feel like a decent human being at the same time. You're helping sweet old ladies eat pancakes and play bingo and live longer through better care. You tell me what's better than that.
So we're hosting a free live webinar called How You Can Create Financial Freedom with Residential Assisted Living. No fluff, just value. And it's happening at 8:30 p.m. Eastern Time, 6:30 Mountain Time. No excuses. It's online. Put on sweatpants. We won't judge.
We'll break down why residential assisted living is the best opportunity right now, the 5 steps to take down your first home, and how to set up a business that makes a real impact and real money.
Spots are limited, so don't be that person who DMs us in 3 months saying, wait, is it too late to start?
So hit up theralroom.com/webinar and register now.
Be the hero your grandma already thinks that you are.
We'll see you there. Pancakes not included.
Yeah, so it's really good. So I'm an investor in a lot of deals, right? And I don't invest in any deal unless they do cost seg. That's just my straight up. If you're not going to do cost seg, I'm not giving you my money, because that tells me that you are not running this the most tax efficient you can. Don't want to have any part of it. I want to be able to get those benefits. I have a full-time job, obviously doing what I do. My husband, we retired him a couple of years ago. He's our real estate professional. So we get to we get to obtain those benefits and be able to use those in our own tax return, and it offsets my income, okay, which is fantastic strategy. And as investors, you don't ever know where your capital stack comes from. You don't know that I classify and file my taxes as a real estate professional, right? So if I am an investor, I'm looking for those tax deductions. I want to see that when this business does become profitable, that I can offset it with my depreciation from the building so that I don't have to pay tax on that income. And the more losses I have, the more I can offset my other income. So I'm looking for that specifically. A lot of people, I can't tell you how many times I've seen syndicators or business owners that say, hey, I'm raising capital, but I'm not going to do a cost seg because all of my investors are passive. So what happens if they're passive, but then they have other passive income? You deliver a negative K1, they can use the negative K1 to offset their other passive income because they can group those together. Yeah. How do you know they can't? They don't have. Trust me, you're not the only game in town. They're probably investing in other places too. So don't just assume that because this is a passive investment for that person, that they are investing and filing their tax return as a passive investor. They could be an active investor in other things, and they could group those things together. And it could also group together, even if they are passive, it can group together some of their passive. Don't just rule it out and think that you know everything, about your investors, because in many cases you don't, and you're not sure. I would say it is your responsibility to make sure that your deal is the most tax efficient as possible.
Yeah, two more things I'll add to that. Depending on their gross income, some of that could still be used a little bit against active. And then guess what? The losses carry over forever. So at some point, they're going to get to use those, or they'll become reps, and then they'll use it that day. Real estate professional status, that's what reps is for the folks listening in. And why that piece is important is that you get to, any sort of passive losses, like a cost segregation study, gets to get put towards your active income. And if you're a couple, that's both of you included, even if only one of you is a real estate professional status, which is incredible because you can reduce your tax brackets while making more money.
Yeah. 100%.
So we've hit some of the myths and misconceptions. Which ones haven't we hit yet, Kim, on cost segregations?
There's a lot of people out there pushing these virtual site visits. And there's a lot of companies that just pop up that have been around for 5 or 10 years that just are. COVID, the IRS allowed us during COVID to do virtual site visits during COVID when we had a shutdown. What happened was these local cost seg companies that were really only operating in their backyard all of a sudden can do projects all over the country because they don't have to physically go there, and they didn't have the resources to go to. They're in California, they couldn't go to Ohio because their costs would be too high. So they weren't doing those. Now what happened was during COVID, that kind of blew up and everyone's, oh my gosh, we're making so much money right now because real estate went crazy. And so they continued to do the virtual site visits, even though the IRS has turned that off. Very clear. And we have had, I will share with you, we offer audit defense on all of our products. And so if there is an audit, we support and defend those reports with the IRS, and you don't have to pay your CPA those billable hours. I will tell you, in the most recent deals, they are catching on to these people who are doing virtual site visits or no site visits or self-certifying, right? These DIY cost segs, like you can self-certify. And you're not a real estate professional. You are not a building professional. You can't tell me that you went in and agglomerated how many square footage or how much lineal footage goes from your lighting or your appliances back to the breaker box. It's almost impossible. And so put your critical thinking cap on, right? We're talking about a tax product, and we're talking about taking hundreds of thousands, if not millions of dollars in deductions. Don't do it wrong. Don't do it wrong, right? Yeah. So don't just think that because you're going to save $1,000, you can go and cut corners and do it cheap, because you will end up, it will catch up with you. So in the most recent audits, which I found very interesting recently, is that the IRS is now asking specifically in the IDR, please send us the credentials of the person who did your site visit. Ooh. Not, was there a site visit? Because they know it's required. But it was, send us their credentials, because that tells us two things. One, you have to have a site visit. Number two, it tells us it has to be a qualified building professional or somebody that fits in the definition under the IRS regulations. So if they're not doing a site visit, or somebody tells you don't have to do a site visit, or you can send me pictures, or you can just upload videos, or we'll do a virtual site visit, you are not a qualified building professional under the terminology and the description of the IRS. Put your thinking cap on. Think critically when somebody tells you something. In many cases, you might be saving maybe $1,000, but there's two things that can happen. One, either you're going to have to get another study done if you get audited to substantiate that, or two, they're leaving a lot on the table. So you're actually getting lower results. In essence, what's happening, what we've seen in many cases over and over, people will have a cheap cost seg, and then they'll come to us and say, hey, I think I need to redo this because yours is way more robust. And how much would it be? And I want to just sleep at night. I want the peace of mind knowing that we had the site visit and we did this correctly, and it's all broken down. It's not a 3-page report. It's a 50-page report. That if you end up going with a cheaper firm, a lot of cases, you're ultimately shooting yourself in the foot. You are literally walking over dollars to pick up dimes, because you might save yourself $1,000. Good job. Great job on the value there. But you might have just dropped $50,000 in deductions off the backside because nobody can substantiate that without physically being there. You just can't. It's almost impossible. So think about it in those terms and make sure that you're looking at all of the facts, not just what the company is telling you, but make sure that you're truly researching it and you're getting a reputable cost seg, because there are a lot of hacks out there. So just be careful. It would be a great caution to leave you with.
100%. You get what you pay for. And so it's something that, of course, I think I had to learn over time as well. I'm guilty, right? Early on of cutting corners and cutting costs. And over time, I've just realized that the ROI on finding the right professional to do the thing for you is so high. And that's one of the things I love about your guys' reports, by the way, is you do it in a way that's easy to understand. It's visual, it's beautiful, and it shows you basically the ROI on your investment, which is a great way to look at it, in a cost segregation. It's like, hey, I'm going to invest, which is, by the way, a write-offable expense. Yeah. And then, but look at my savings. If you just look at it in that context, instead of worrying about the few $1,000s right now, and look at how much money you're going to save in the long term that you can reinvest and build your empire off of, you're going to do so much better in literally everywhere, right? Yeah. Hopefully folks listening are picking up what I'm throwing down, because it pays to have the right tax professional, the right cost segregation team and basically everybody on your team. You get what you pay for. And I guess that's enough said about that.
Yeah. Not all cost seg studies are created equal. And I think people think that, hey, if I'm going to have a cost seg study and this guy is $1,500 cheaper than this one, they're the same. You're not getting the same. They're not equal. If there's that much differential in the cost, I guarantee you there's somewhere that they're cutting corners. They're either not doing a site visit, or they're trying to do a virtual site visit, or they want you to upload the pictures or something like that. Those are all signs. So keep an eye out for that. Make sure that you're looking at it appropriately. But yeah, it really does make a huge difference and it's not just, hey, we'll send somebody out there and then they hire a local photographer, right? That when you send the credentials to the IRS and it was a photographer, how is that photographer going to know the breakdown? Because we're not just going there to take pictures. That's not the point of the site visit. The point of the site visit is to figure out what all the components are of that building. We need to see the layout of the building, the square footage. And a lot of people don't have their blueprints, so we don't have that on paper. If you do, it makes our job a little bit easier. But how are you going to know how many elbows are behind the walls in the plumbing, right? I mean, how do you know how much? I talk about the lineal footage of electrical. All of your electrical that services those appliances or those chandeliers or the specialty type items, the TV outlets on the walls, all of those things, all of those, the wiring that services that asset all the way back to the breaker box also constitutes a shorter class life. Okay. Most people, if they don't send a photographer, they're just going to put all the electrical in a long term. So you're going to lose that because they're going to put it in a 27.5-year bucket when part of it can go into a 5-year bucket. Huge difference. And that's where you start to see the benefits over and over with each of the individual asset classes inside that building.
Yeah. Yeah.
Okay.
Yeah. Got to do the right study. Got to have the actual person come to the site and evaluate it. So just keep that in mind, folks. Kim, when it comes to being able to take the cost segregation deduction, I believe it happens once your property is in service. What exactly does that mean?
Yeah, good question. In service for a RAL would be when it is, because it's technically a long-term rental, right? So it's going to be when that property is available for marketing. Okay. So it's different than if it was a short-term rental. If it's a short-term rental, it's the date of your first guest. So this is very different. You have to be ready to accept revenue. So you have to be marketing that. You don't have to have revenue when it's a RAL, but you do have to be available and ready to accept rent. So you got to be marketing and saying, okay, this property is ready to go. People could move in. It could also be your substantial completion date, right? If it's a new construction, or your certificate of occupancy, but then again, you might have a lot of things that you probably have to furnish and whatnot. So maybe some people do it furnished, maybe some people don't, but just depends. Yeah.
Okay. Here's another question. Maybe it's one for me personally, but is there a property price or a property cost where it makes a cost segregation worth doing, right? Like obviously maybe on a $50,000 whatever, maybe that doesn't make sense, but is there a line? Is there a rough idea, or does it just depend?
Yeah, I haven't met a building yet that really didn't constitute a cost seg. You can do a cost seg on anything. It will pencil out. I would say it depends on the bonus depreciation, because the bonus depreciation is 80 or 60 or 40%. Then your returns the first year aren't going to be as big as like the first 5 years. In those cases, I would say $50,000 or less, like maybe don't worry about that, but it still pencils out. It's just that it's not going to be as much. So we can run the numbers for you, but to be honest with you, any property is going to produce a good ROI. The bigger it is, the better the ROI, obviously.
Yeah, love that.
Yeah.
How does a development differ from, let's say, existing ready to go or renovating? Is there any sort of big differences in the cost segregation, or is it all all the parts and pieces are looked at the same way?
Yeah, there's not a ton of difference. The biggest indicator to us is the property type. What type of property is it? Because say a medical office building is going to be very different than a RAL, or a distribution center is going to be very different from an office building, right?
Mm.
So it really, that's more indicative of where you're going to see the fluctuations, because you see a lot of similarities in the construction of those types of properties. New construction versus a purchase probably isn't going to differ too much. It's really going to come down to the construction.
Okay. Good to know. We already talked about this one, but I just want to recap because I think this is like the biggest cheat code in real estate. A cost seg and then a 1031. Like, why, first off, why is that even allowed? But also, how can assisted living or other investors really take advantage of that?
Yeah. A cost seg is just so wildly beneficial. And it comes down to the accounting, right? So if you do straight line depreciation, you still do a 1031 exchange. When you do a cost seg, you get to keep more of the benefits, and then you do the 1031 exchange. And it's a way to offset. 1031 exchanges have been around for decades, right? Mm-hmm. This is something that you can essentially, the government says, hey, if you have this big capital gain that you sold from this building, they're incentivizing you to go buy another one. They want you to put that money back into the market. So it's an incentive. The government gets to turn on and off their incentives as they see fit to increase the GDP. And this is one of the things that have been very popular in, hey, if I have a big capital gain coming, I'm not required to have to pay all that tax. I can roll that in if I was to go buy another property. It continues to build the economy, right? So it's a benefit to everybody. If you keep that money in real estate, you're just usually buying bigger and better, right?
Yeah, that's huge. That's huge. Okay, so we have someone who wants to open their first assisted living home listening. What should they not do that would limit their ability to take advantage of a cost seg? Or conversely, what should they do to ensure that they can do it?
Yeah.
I think you mentioned entities earlier.
Yeah, obviously the structure is really important. Make sure you have a good attorney for your structure, especially if you're going to do of self-rental rules, and get your CPA. I would say make sure you have a good CPA that understands what you're doing. I literally still have clients calling me doing the cost seg study. I'm like, yeah, you can do the self-rental rules. They call and say, my cost seg didn't turn out through my tax return like you said it would. Well, what's going on? I said, send me your tax return. I'll take a look at it. They never took self-rental rules, right? So they never took that. And so they couldn't use that. So what the CPA had done was locked up the property into their passive side, and the business was on the active side. When you have self-rental rules, it jumps the line, and now it becomes ordinary, so you can offset the income. Make sure you have a good CPA that understands this. All right, make sure they're a real estate CPA, they specialize in it. That's going to be a really good place for you to start. And then get a good cost seg study. Please don't cut corners. Just don't be cheap. I'm not saying we're extraordinarily expensive, because we're not. We're very equal as far as pricing out. We're probably in the middle. We're not the most expensive. We're not the cheapest, but we will get you the best benefits. And so I would just be really careful. And the other thing that I would caution against is just take stuff you get on the internet with a grain of salt. I'm just going to tell you, like, there are so many people out there that are telling you can do certain things that you really just can't. And I see some of these YouTube videos out there of people who did one cost seg study in their lifetime, and they're like, oh my gosh, this is the best thing since sliced bread. You should do this on blah. And there's just some cases that probably aren't going to benefit you, and you're getting some misinformation. So make sure that you understand the rules. And also the other thing, like ｃhatGPT and AI is a great tool. It is a great tool. But I will tell you, think about it. Think critically. You are a human being. You are not a machine. So what's happening is there is so much misinformation on the internet. And AI is pulling in all of it. So you may be getting some misinformation. And let's say if you go and you're going to go buy something as a consumer and you want AI to go compare them for you, that's all great, but they're going to be taking reviews from people that may be false. If you're in marketing, he knows you can put false reviews out there. You can put all kinds of stuff out there, whatever you want. And AI is pulling all of it because it can't differentiate what's fake and what's real. It's pulling all of it. So there are some statistics that AI is actually so messed up because there's so much misinformation on the internet that it's hard to get through that. So don't rely on all just computers. Really make sure that you are talking to multiple people. You have a reputable CPA, you have a good attorney who understands and knows what they're doing, and listen to them. They're there for a reason. Just do it right. Don't get caught up in some of the mishype or some other things, and just be careful.
That's such good advice. And I use ChatGPT daily, and I see that exact thing you're talking about. Like, you still have to review what it spits out because you're right. A tool is only as useful as the information being put into it. And that's a combination of what you're putting in there and literally everything else on the internet. So not everybody's as smart as they claim to be.
Yeah. And I use it every day too, but just be selective and just look at it through your critical thinking, right? Be a human being, be what the computers are not. Because that's really what sets us apart. And it really does make a difference if you're critically thinking through some things logically.
Yeah. Kim, this has been awesome. I hope folks are just as fired up as I am. I've got more ideas I wrote down during this of some things I can do. I'm going to be looking into that, and you'll be hearing from me. Okay, so if folks, let's say they have a property, they think maybe I missed the boat and I need to go back and get my benefits, or I'm about to set up an assisted living home, or I just purchased one and I need to do this thing, or I'm developing and raising money and I'm bringing investors in and I need to do this thing for their sake. What's the best way that folks can get a hold of you to go ahead and take a look at doing a cost segregation study?
Yeah, thanks, Charlie. I appreciate that. You can send me an email. It's just my first initial and last name. So K Lockridge at engineered with ED on the end, tax services with the S on the end.com. And so that's our website, engineeredtaxservices.com. My email address is also on the website under our team. So you can go there and just reach out to me on the email and I'll be able to get you a quote, and make sure you heard us on Charlie, and we'll get you there. I want to leave you with one of our favorite quotes. And
let's hear it.
We do believe that everyone should pay tax, but there's nothing in the code that says you have to leave a tip. So we are in the business of taking the tip off the table, and we want to apply these benefits that are allowable to you. I get the question all the time: does a cost seg study and taking a $300,000 deduction over $30,000 trigger an audit? The answer is no, it does not trigger an audit. This is a tax benefit that has been around. That's like saying that because I filed a 1040 EZ that I'm going to, or a 1040 and I'm itemizing my deductions, that I'm going to get audited. If you're doing something blatant with your taxes and things don't match up, then you might be triggering an audit, but it's not because of the cost seg study. So it's not an aggressive stance. Like, again, this is a cost segregation has been around since the 1940s. It's allowable. It is substantiated by qualified building professionals as long as you're doing it right. So don't leave the tip on the table. And then that's what I can leave you with.
Hell yeah. Love that. And if you guys need help getting connected to Kim, you can always reach out to us as well. team@theralroom.com. We'd be happy to help. And Kim, this has been absolutely a blast. Maybe we can have you back on to talk about 1031s here in the near future. We'd love to do that.
That'd be great.
Anyway, thank you so much for your time. This was awesome.
Good. Thanks, Charlie.
Thank you for tuning in to the Ral Room Assisted Living Podcast. We hope you found today's episode insightful. If you enjoyed it, make sure to leave us a raving 5-star review. And a quick review helps more listeners find the show and more seniors get the exceptional care they deserve. And don't forget to subscribe so you never miss an episode. And just so you know, we have prepared some free resources for you to help you succeed in residential assisted living in addition to this podcast. Head over to theralroom.com, that is theralroom.com, to download our free 10-step guide to launch your first or next residential assisted living home, or our 10 reasons to passively invest in residential assisted living ebooks. And if you're ready to take the next step and make real moves in the RAL industry, join us in the Ral Room Mastermind. It is an exclusive community where we deep dive into everything you need to launch and grow your own residential assisted living business. You'll get access to recorded courses, live calls with industry experts, a Ral calculator, resources and tools, like-minded entrepreneurs, funding opportunities, and an expert networking community to help you along your journey. Be sure to join us next time on the Ral Room Podcast as we continue to explore the world of residential assisted living with more great guests. See you then.